So, and there are other signs. I don't need to kind of go through all of them, but whether it's technical signs such as an inverted yield curve warning us, and then a now uninverted yield curve, a normal yield curve telling us the danger is already here because rates are dropping at the short end, plus a lot of other signs of liquidity and other and labor being not as robust as we've been told, and other signs all add up to a very serious warning of recession. There are a lot of signs of recession or coming recession. Now I know GDP was very solid for the third quarter, and Atlanta Fed GDP tracker, was off to a good start for the fourth quarter. So I understand the data, but there are a lot of signs behind the curtain that some of them highly technical, and we can kind of explain in plain English. But I'm looking at, for example, as you know, there's a lot less there than meets the eye in terms of the monthly employment reports. There was a long string, it's kind of 12 out of 14, which is statistically, if not impossible, definitely extremely unlikely, of downward revisions where the report would come out first Friday of the month, prior month, so many jobs created, whether it's 200,000 or 300,000. And then the following month would come out and they say, well, now we created 250,000 jobs. But oh, by the way, prior month we revised down 80,000. It's like, well, wait a second, your 250 was actually 170 and so forth. But that happened month after month after month. The Bureau of Labor Statistics did an annual revision, a major revision, where they wiped out over 800,000 jobs just as a statistical adjustment. And then when you combine that with the monthly adjustments, there were a couple million jobs that disappeared that we were led to believe were created at the time. And, analysts kind of caught on to this and they gave it less and less credence. Now, the most recent jobs report, we saw that the reported number was 12,000, which is nothing. It's positive. And most of that, not most of it, but a lot of it were government jobs. And when you strip out the government jobs and say, well, what did the private sector do? It was negative. We lost jobs. So, and employment, as people know, tends to be a lagging indicator. So when you see trouble showing up in the employment markets, you may already be in the recession. You just don't know it yet. I mean, the National Bureau of Economic Research, that's they call kind of balls and strikes, and they're the ones who decide when a recession begins and when it ends. It's not a government agency, but they're all, it's like 12 or 14 PhD eggheads who, most of whom have been in government service or all in academia one time or another. But a lot of times by the time they declare a recession, it's already over. Meaning if a recession is 6 months or 9 months and it takes them 9 months to make up their minds, it's like, well, the recession started, last January or whatever. Like, well, thanks a lot. We've been living through it. We think we knew that. But, and that's okay. I'm not faulting them. I'm just saying that, you can be in a recession, not even know it. You feel it. It might affect you or your neighbors or your business, but there's nobody waving a flag saying, hey, it's a recession. And B, by the time the scorekeepers jump in, it could already be over. So that's one sign. And then within that, just to kind of parse the numbers a little bit, the vast majority of these jobs are going to non-citizens, some legal, some illegal, but none of them U.S. citizens. And they tend to be, not exclusively, they tend to be at the low end of the wage scale. So what's happening is, I'll refer to illegal immigrants in particular. These are the people working for $5 an hour. They're lined up on the expressway entrances, and you pick them up and they'll come, clean your yard or whatever. But if you have enough of those $5 people, the legitimate worker making $8.50 or $9 an hour can't get a raise. Like the $9 guy wants to get up to $12, but if there's a $5 guy waiting in the wings, you don't get that raise. And likewise, the $15 person can't get to 20 because these low income, low wage workers are dragging down the entire wage scale. And that, by the way, is one of the reasons why a lot of big, well-known companies favor all this illegal immigration, because they're the ones hiring, if not $5, maybe $10 an hour people. So A, the labor statistics have been overstated. B, when you adjust them, the economy is a lot weaker than it looks. The jobs that are being created are going to illegal immigrants, and real wages are lagging. So all of this is very bad for consumption. People are just, if they can barely afford to, eggs, bacon, bread, gas, and groceries, and gasoline. The demand for gasoline is inelastic. Like, you need it. It doesn't. You want a lower price, but it doesn't matter how high the price is. You have to pay it because you have to get to work or take your kids to school or drive your pickup truck on business or whatever it may be. Then there are some more technical indicators, but they're there. We had, beginning about a year and a half ago, we had what's called an inverted yield curve. What's that? Well, a yield curve is just a graph. The y-axis is is interest rates. The x-axis are the maturities of certain securities, particularly treasury securities. So 1 month, 3 months, 6 months, 1 year, 2 years, 5 years, 10 years, all the way out to 30 years. And the curve generally goes up from lower left to upper right, which is what you would expect. You say, hey, if I'm going to lend you money overnight, I might want a certain interest rate. But if I'm going to lend you money for 10 years, I want a higher rate because I've got risk. There's inflation risk and sovereign risk and a settlement risk and a lot of other risks, geopolitical risk, et cetera. So that's normal. But about a year and a half ago, the yield curve was inverted, meaning when you move from left to right, it was going down. Well, what's up with that? Well, first of all, it does happen. It's unusual, but it does happen. And when it happens, it's telling you something. I think, well, why would I take a lower interest rate on a 5-year note than a 4-month bill? And the answer is that I think interest rates are going to come down. I think we're heading into a recession. In other words, that I'll say, 4% yield on a 5-year treasury note might look really sweet in a world of 2% interest rates or 1% interest rates. If you go into a recession, interest rates are going to drop a lot. They're already dropping at the short end. So I will take a lower yield, meaning the inverted yield curve. So when 3-month treasury bills were around 5.25, you go out to the 10-year note, it was 3.8. And it's higher now. It's about 4.25 today, but at the time it was kind of 3.8. That's the smart money saying, I'll take the lower yield because when we get further out the curve as time goes by, interest rates are going to collapse and that yield is going to look really good. Now, right now, today, as we speak, the yield curve is upward sloping again. In other words, it's a normal yield curve. It has uninverted. What does that mean? Well, the inversion was a warning saying the recession is coming. But now that it's uninverted, it's saying the recession's here. In other words, intermediate and long-term rates are not going up a lot. They've gone up a little, but short-term rates are plunging. And everyone's saying, oh, the Fed's cutting rates. The Fed's going to stimulate the economy with rate cuts. Nonsense. I mean, the Fed is cutting rates, but that's not stimulus. That's a sign of a very weak economy. When did we have low rates? Well, the Great Depression was one, and we had zero rates from 2009 to 2019, which was a long recovery, but a period of very, very weak growth. Or average annual growth rate for that 10-year period was 2%, which is way below trend, which is closer to 3.5. So, and there are other signs. I don't need to kind of go through all of them, but whether it's technical signs such as an inverted yield curve warning us, and then a now uninverted yield curve, a normal yield curve telling us the danger is already here because rates are dropping at the short end, plus a lot of other signs of liquidity and labor being not as robust as we've been told, and other signs all add up to a very serious warning of recession. Now people go, wait a second, Jim, stock market's had an all-time high. It is. I get it. I look at the ticker like everyone else, but who's to say it's not a bubble? People always say, bubbles. You can't call it a bubble. They're really hard to spot. That's nonsense. There's nothing easier than spotting a bubble. Just look at the Nikkei index in 1989, the .com NASDAQ 100 composite in 1999, 2000. Said bubbles are easy to spot. What's hard is knowing when they're going to pop. That is difficult, and you don't want to run out and short the market just because it's a bubble, because you can lose a lot of money being right. I mean, you might be right that it's a bubble and you short the market, but that bubble can expand and the market can go higher. In my view, that's the phase we're in. It's going to break and break hard. Don't know when. And I'm not saying short the market. I am saying just beware.
Summary. While economic indicators like GDP and stock market highs might paint a rosy picture, it's crucial to look behind the curtain at multiple technical indicators for a complete view of economic health. Rickards points out that even when surface-level metrics look positive, underlying factors like wage dynamics and technical indicators can tell a different story. This emphasizes the importance of comprehensive analysis rather than relying on headline numbers. Investors should pay close attention to yield curve dynamics, as they can signal significant economic shifts. Rickards explains that an inverted yield curve, where short-term rates are higher than long-term rates, is a warning sign of an approaching recession. However, when the yield curve uninverts and returns to normal while short-term rates are falling, it might actually indicate the recession has already arrived. This is because falling short-term rates often reflect economic weakness rather than stimulative policy. Employment data revisions can reveal a very different economic reality than initial reports suggest. Rickards points to a pattern of downward revisions where the Bureau of Labor Statistics repeatedly adjusted previous months' job numbers lower, eventually wiping out over 800,000 jobs in an annual revision. When combined with monthly adjustments, millions of jobs that were initially reported as created simply disappeared. This demonstrates why investors should be cautious about making investment decisions based on preliminary economic data and should pay attention to subsequent revisions.